Welcome to the monthly 3-Edge View from the Edge for November 2024. I'm Fritz, Folts, the Chief Investment Strategist here, and joining me here once again today is Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3-Edge Asset Management. As we do each month, Eric and I will provide our firm's most recent outlook for the global capital markets, and that is based on our proprietary 3-Edge research model. Before we get to our research model outlook, the recent election results proved to be a surprise to the global capital markets. Not only did Donald Trump win the presidential election, but by the day after the election, it was clear that the Republicans would take back control of the Senate and were on the verge of maintaining control of the House of Representatives, which they subsequently did. And with the Republicans firmly in control in Washington, in the 3 days following the election, investors rushed into the Trump trade with abandon at the prospect of the Trump administration policy goals of deregulation, tax cuts, and tariffs. Policies were seen to be pro-growth, pro-business, particularly pro-U.S. business, but also potentially inflationary. U.S. equities and the dollar surged. The decisive victory by Trump sent a broader swath of U.S. stocks beyond just the Magnificent Seven higher. And then 2 days after the election, the Fed came through with their highly anticipated interest rate cut, which seemed overwhelmed by investors' reaction to Trump's victory, and it came and went without much fanfare. However, the brief surge in U.S. equities seems to have petered out a little bit this week as investors return their focus to the inflation outlook, which had been steadily declining, maybe stalled out here a little bit above 2%, and investors just becoming more nervous that Trump policies could continue to increase U.S. government debt, pushing interest rate higher, and potentially reawakening the bond vigilantes. So, as often the case, there is much uncertainty hanging over the market. So let me bring Eric into the conversation, see if we can provide at least some clarity from our most recent outlook. And Eric, why don't we start by digging into the 3-Edge asset class matrix and see what's changed?
Great. Thanks, Fritz. Yeah, we can see here in the asset class matrix some movement, mostly from right to left. That is, things getting less attractive while some things staying where they are. Like the U.S., as you discussed with the rally that we've seen in U.S. equities, that maintains a positive outlook. We'll dive into some of the details that we're seeing there. International equities, less so. Europe and developed Asia maintaining that negative outlook. China and broader EM getting knocked down a peg there to the mixed or neutral outlook, alongside India also getting knocked down a peg there. Rates even moving down a peg, and gold moving down just a little bit in between that mixed to positive range. So a lot of movement downward, really, for everything that really isn't U.S.
All right, great. So let's start then, go into the major asset class groups, and we'll begin with equities. And so let's take a look at the U.S. equity markets. What is the model showing us there?
Yeah, the model research is maintaining a positive outlook, like we just said. The S&P 500 has continued to reach record highs post-election. And while still highly overvalued by our measure, the economic and the investor behavioral factors within our model continue to indicate that positive outlook here in the near term. You know, we're seeing declining short-term yields from the Fed's loosening of monetary policy by lowering those short-term rates, which that remains supportive of U.S. equities. But we've also seen the long-term yields increase, and that's acting as this countering force for U.S. equities. Taken all together, though, it's still a net positive. However, those long-term rates continue to rise. That could become problematic.
All right, let's shift then outside the U.S. to ex-U.S. equity markets. So why don't we start with Europe?
Yeah, the research suggests the negative factors here outweigh the positive ones for European equities. The yield curve, as we measure it for the region, although it's inverted, is heading in a steepening direction. So less inversion, and that is a positive. Yet the yield curve measure on an absolute basis, it does indicate weak economic growth. So with a lag, continued decline in the short-term rates by the European Central Bank, we may see that steepen to the point where that could become attractive down the road, but just not there yet.
All right, great. So let's move over to Asia and look at Japanese equity markets. What's the model indicating there?
Yeah, also maintaining a negative outlook here. We've seen the weakening yen has continued to make investments in the region challenging. There have been reports for the expectation of currency intervention by the Bank of Japan, But for the time being, this remains, uncertain, both in terms of timing and scale, maybe what level they would act at. And so just a little challenging to be invested there. Beyond that, we've seen some tightening in credit spreads, and that's generally a positive factor for the region, but this hasn't been enough to offset that negative influence from the potential currency intervention. The shape of the yield curve in Japan, as we mentioned, it also a negative for the time being. So taken all together, net negative still.
All right, great. So let's shift to the emerging markets, including China. And what is the model research saying there?
Yeah, well, the efforts by the Chinese government so far to stimulate their economy have clearly just not satisfied investors' desire for, a stimulus package. So it seems like more is going to be needed, particularly focused around the property sector. We have a new incoming presidential administration, which have investors' expectations of increased tariffs on goods and services. This is likely to make it even more challenging for a turnaround in the region here in the near term. And this will no doubt have significant impacts on broader emerging market equity investing. Our model research has a more mixed outlook on emerging market equities, which are being heavily supported by the Federal Reserve's continued loosening of U.S. interest rate policy that we discussed. However, another growing headwind is the broad strengthening of the U.S. dollar following the U.S. election. And as companies in the emerging markets often borrow in U.S. dollars, they might find it challenging to service this debt in U.S. dollar terms with their weakening local currency.
Yep, that strong dollar is not helpful for the emerging markets. So let's look at, one more market, and that would be India equities. What are we seeing there?
Yeah, the long-term growth outlook remains very favorable for India, but nearer term, the outlook's a bit more mixed. We've seen some widening in credit spread measures, a reversal in equity market momentum measures, and we've seen a recent uptick in inflation, which has generated some concern shorter term.
All right. So now we'll move out of the equity markets and take a look at the bond market, where there's also been a lot of activity post-election. So what's the current outlook for interest rates, beginning with the U.S. Treasury market? What is the model saying there?
Yeah, we've seen the shorter-term U.S. Treasury yields declining with the aid of the loosening U.S. monetary policy by the Federal Reserve. But as mentioned, right, the yields on those longer-dated U.S. Treasuries have continued higher. So in the near term, this just continues to be supportive of concentrating our fixed income investments with those having those shorter-term maturities and less interest rate risk.
All right, and let's look at the corporate bond market, where I know that you've discussed over the course of the past week how credit spreads are just so tight there. What's the model indicating there?
Right. Yeah, the current credit spreads are at multi-year tights, and that's suggesting very little additional return given the level of risk embedded in a credit investment. And so as a result, sound like a broken record, the outlook for the corporate credit markets just remains cautious from our standpoint at this time.
Yeah, fair enough. Let's look now at what we would call real assets, hard assets, including both gold and commodities. And why don't we begin with gold, and what is the model showing for gold?
Yeah, gold's been one of the best performing asset classes year to date, neck and neck with the S&P 500. It's outperformed the S&P 500 on a 3-year basis, on a 25-year basis. So it's really been a terrific asset class to have in one's portfolio. The longer term outlook remains favorable with the continued geopolitical conflicts we see on multiple fronts, excessive federal debt levels that are only likely to increase, but there are a growing set of potential headwinds that has us a bit more concerned. That includes rising real rates, that is inflation-adjusted rates, and the strengthening of the U.S. dollar in response to the outcome of the election that we just discussed. So continued loosening of monetary policy by the Federal Reserve, the potential for declines in U.S. real rates, and escalating geopolitical risks remain potential positive factors to watch for in the months ahead. So overall, the outlook is still slightly positive, just less so perhaps than it was even a month ago.
All right. Now let's stay in the hard or real asset category and look at the commodities market. What's the model seeing there?
Yeah, as we discussed, the prospects for a series of rate cuts by the Fed, the potential for increased monetary and fiscal stimulus from China, and an escalation in the Middle East conflict, this could perhaps, drive the price of oil higher. All of this taken together could be supportive of higher commodity prices in the months ahead. However, as is the case for gold, like we just said, the shorter-term headwind of that strengthening U.S. dollar may hurt this outlook in the near term. For now, not so much, but we remain vigilant on that.
All right. Excellent. Eric, thank you very much. Updating our current outlook, particularly as it relates to our research model. Appreciate that. So that will do it for this month's 3 Edge View from the Edge. Eric and I will be back again in December with another edition of the monthly View from the Edge. If you'd like a hard copy of this newsletter for this month, you'll find that on our website. And as a reminder, our entire library of video content is always available on our 3 Edge YouTube channel. If you think that someone you know might benefit from the videos, please feel free to share them. And if you do appreciate these videos, you would be so kind as to subscribe to our 3 Edge YouTube channel. We would be most appreciative. So, on behalf of Eric and everyone here at 3 Edge, thanks for listening.